Hi, my name is Amy. Thank you very much for watching, and let's make some bad financial decisions together. This is for entertainment purposes only. Do not take any financial advice away from this, and if you are entertained, please like and subscribe. I would really appreciate it. Today, we're going to talk about XPAY, and I'm really excited about this because Roundhill is not messing around with their swing at SPYT. So this is in direct competition to Defiance and their answer to a target 20% distribution fund. So I'm excited because SPYT is a covered call ETF. It's pretty traditional. They just want to target 20%. But Roundhill is taking another more subtle swing at WDTE as well, because WDTE, they sell puts that are in the money, and they have been honestly like a dividend trap. They're trying now to salvage the fund, but it's been a wild ride with WDTE. But Roundhill said, we will do in the money, but we will do in the money better by buying calls. So how this works for XPAY is they take the value of SPY on the last day of the year, and they are targeting a 20% distribution return for the year. So I don't know if everybody is familiar with this, but when you buy calls and there is enough time, the theta decay is not very prevalent until you get really close to when, or relatively closer to when it expires. So it's like a flat line, and then just like drops off a cliff. So here's how I think because they're doing flex options off of SPY and they're buying them. So if SPY is worth $580 now, they might put out a contract. And if I know Roundhill, they're going to be between like 5 and 15% in the money. And there is significance to that, but we'll just say it's a strike price, and they've bought it for $1,250,000. And then at the end of the month, when they need money in order to do distributions, SPY is now at $582. And the option has actually appreciated in value since then. So they're now able to sell to close the position, and they've made $250,000 of profit. And that is returned to the investor as a return of capital. So in this scenario, this is a good scenario where SPY behaved good and it has risen, and so the intrinsic value has definitely gone up. And it's by doing it in the money, SPY can go down a little bit and it won't be bad for the investor right away. And since I don't really go into the intraday trades, but I do trust Roundhill to pick a strike price that they won't be losing their trade every week. So, and half of the battle, or actually probably more than half of the battle with options trading, is just not losing. So even if it's worth $580 and you buy at $490, which is 15% out of the money, as long as SPY and the S&P 500 doesn't fall 15%, you've still won. And depending on how far out the calls are, they'll be able to sell it to close for a profit, even if it falls a little bit. So this fund will do well in a flat and not really volatile market, or a going up, like a good bull run market, but not too much volatility. But it will do really bad in a prolonged bear market or an extremely highly volatile market, and those two things combined, obviously. So this year, the last day of the year, SPY closed at $475.31, and it's already increased 22% this year. So I don't think that Round Hill's, they're like, I don't think it's a particularly hard goal that they've set for themselves, because with options, you can pretty much get a 20% return anyways, even when the market's only returning a lot less than 22%. So if I did my math correct, and I am really unsure, if the share price opens at $50 tomorrow, or I guess today when I'm putting this out, I would expect the first if their first distribution is on November 1st, it should be about 83 cents. And I'm hoping that is correct, because that means that I can do math. But if it's not correct, we're going to have to look more into this and figure out why my math is bad. But I am not, I repeat, not putting my money in this for now. There's a few reasons for this. Nobody else is just using buying calls as the way that they are making money for their fund yet. So this is a first to market, and there's no historical data, so we don't know how this is going to do. This is going to have a 100% margin maintenance, and as I told you yesterday, I'm kind of have a bit of a problem with my margin. I'm trying to get it in a better shape. So, I'm already in trouble. So, we will hold off for now. And it doesn't take a genius to say that November is going to be pretty volatile. And, we're all going to have to hold our breath anyways. And timing the market and looking forward to the market is not a good thing, but I'm kind of wary about January in particular. So if it was a good fund to buy into in December or January or February, it will be a good fund to buy into in March. And I'm not even that concerned about the return of capital, because this would actually be in my taxable account. So if I buy into this and its return of capital, it's actually tax advantaged. And as long as I never sell, then this is actually kind of a good thing to have in a taxable account. And return of capital is just an accounting trick that ETFs use. So I'm not that concerned about it, because this is actively managed, but their management fee is pretty low. And the reason for that is that they're just buying calls that are deep. Well, I don't even know how deep, but I'm going to assume they're pretty deep in the money. So it's not going to be like a 0-day to expiration type situation that takes a lot of management, but it is managed. So I think that this is going to be interesting, and we'll see if they manage to win their calls and make money, or, if this is just another failed experiment. So, what do you think about XPAY? And are you excited about this? And what is the next gimmick that someone should try? I will talk to you later. Bye.